So we have a lot of partners that help us do what we do. Law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, a lot of players in the Silicon Valley startup ecosystem. And we're grateful again to Wilson Sonsini. We have one of our other partners here tonight, Focus Product Design. So I'm going to have Maureen from Focus Product Design come up and say a few words. Let's hear it for Maureen.
So we are a full-fledged product design firm in Menlo Park at O'Brien and Willow East, so right over the Freeway 101. And we actually are very, very good for startups in terms of affordability for full product development, mechanical engineering, electrical engineering. We have a very deep bench in EE, especially for medical devices, industrial design, and design for manufacturing. So one of our strong points is that we actually are aligned with about 100 factories in China, and we have US managed sourcing and management for those factories. So sometimes that's very helpful when you want to make sure that your instructions are translated well to the manufacturing team, and it seems to work really well. We can actually do manufacturing in volumes of 500 to several millions. So it's very flexible, and we like to tailor our design jobs to your needs. So whether you're, a real startup, you're an entrepreneur, you're an inventor, and you really want to flesh out your project, we're extremely good at that because the company was founded on working with people like that. And now I'm the beginning of the outbound business development team that is working with larger corporations and also helping entrepreneurs and solo inventors actually bring their product to life. So that kind of breadth you won't always find in the product design firms in the Valley here, but we actually love to serve the single inventors, these very small startups, the innovators, incubators, accelerators, and also large corporations. So right now we're doing a lot of medical device work, and we have some brochures on some of those projects in the back at the table at the left side. And our website is up so you can take a look. We just launched that. So thank you for your time.
Okay, so without further ado, we're going to get into the program. Who here is an early stage entrepreneur? Okay. You guys have a good sense of humor? All right, I'm going to deliver a joke here that if anyone gets offended, I understand. If you have to leave, that's okay. So what's the difference between an early stage entrepreneur and a pizza? A pizza can feed a family of 4. But luckily, there's no pizza tonight, so yeah. Without further ado, I want to introduce our featured speaker. He's an attorney at this prestigious firm. He's a leader in his field. He's a dynamic speaker. He's charismatic. He's exciting. He's really funny. No pressure, right? Okay. Yeah. All right, let's hear it for Asaf Kharal.
Thanks, Rob. Hi, everyone. Welcome, and glad you could all be here tonight. Thrilled to be hosting tonight's event. Our firm, has a long established tradition in the Valley of supporting entrepreneurs and the startup community. We were a startup law firm as well at one point in time, and frankly always will be. So don't let sort of the fancy offices fool you. We do work with many very early stage companies, and personally, I practiced in New York for about 5 years before coming out here to Silicon Valley, and the ivory tower mentality in a New York environment, probably still exists today. But out here, I was amazed by the amount of energy and resources that individuals and Wilson Sonsini devote to early stage startups. We take early stage companies very seriously. We believe in them firmly, and we commit the full resources of the firm to helping the startup community, because ultimately that's where the companies of the future will come from. Not every startup company will emerge as an industry leader, but many of them do. And we have clients like Tesla or Solar City or Google that came to us as early stage startups as well one day, and it's because we believed in them as early stage startups that we still have strong relationships with those companies today. So certainly, that's part of the reason for us to host the event tonight and support the community that Meetup and Rob have cultivated here. I've been to a few events that Meetup and Rob through the Idea to IPO program have organized, and always impressed by the speakers and the audience. So hopefully tonight's event can live up to that standard. Certainly, I think from the perspective of early stage financing, I mean, certainly it's a broad topic, and I mean that's the overall topic for tonight is early stage financings and startups, and strategies for raising funding, strategies for getting a business off the ground, positioning a company for attracting venture financing or angel financing or any type of financing, is a broad topic. So, what we'll focus on tonight is, initially sort of a little background about the firm, but then once we get past sort of the usual sort of marketing material, we'll talk about sort of some of the trends in the early stage financing market. I think, certainly there's been, a sustained level of activity, an increasing level of activity in the startup funding and financing sector over the past few years. I've been with the firm for about 15 years now, so I've seen a lot of ups and downs in the valley. And, there's definitely something different about the current environment. It's one of sort of rational exuberance. I think there are savvy investors out there. There's funding available for companies, really at all stages of development, from early stage to late stage. But that investment is rational. It's sophisticated, and certainly positioning a business for funding and attracting that level of interest is a complete subject area in itself that could take days to cover. The focus tonight will be on sort of what's happening in the capital markets for private companies, what sort of trends are emerging, what kind of investments are being done, and then what are the different alternatives for a startup company in raising funding, in terms of structuring that funding. What are some of the pros and cons of each alternative? What are the differences between them? And what are the types of funding structures that you might consider or get offered once you get past the initial steps of convincing an investor that there's a viable business, a compelling business plan and strategy? How do you translate that or convert that into an actual investment in your business, and what will that investment look like? Early stage financing is certainly the most important financing that a startup company, whether it's a technology company or another, a brick and mortar company, will do. It's at a time when your business has not matured, and so the valuation is not what you hope it will be 5 years from now. Typically, your early financings are at the lowest valuation that your company will have, and so they're typically the most dilutive financings. And so certainly managing the type of financing you do, the terms of that financing, can have a big impact on your company for years to come in terms of ownership in the company, rights in the company, control of the company, and so on. So certainly that's the general subject matter and theme for tonight. I personally, represent companies at all stages of growth, from early stage to late stage. I sit in on a lot of pitch events as well, where folks will, present ideas to a panel of investors and attorneys to get feedback on ideas. That's always interesting, and I'm always amazed at the amount of passion and energy that people put into their pitches and their business ideas, and whether they're great or not. I mean, I certainly respect that, and respect sort of the investment that people place in themselves and their ideas. I've been to events, or I've been on panels where you'll get a mix of different ideas, and you always want the more people you talk to, whether they're friends or strangers, experienced startup professionals or inexperienced, getting that feedback on your ideas is always critical, always important, and always helpful. I mean, there was one event where we had a few interesting pitches, but one really caught my attention where an entrepreneur was talking about reducing dependence on fuels for airplanes and aviation, and converting sort of the airline industry to electric power, which seemed compelling, provided, and I figured, must be some sort of, and I hope this person's not in the audience tonight, but it was, I assumed it was some sort of lightweight battery technology that would enable, airplanes to actually travel on electric power. But in the end, when he revealed sort of the methodology for converting the industry, it was actually, believe it or not, extension cords. So, we do get a mix, definitely a mix of ideas at these events, but I definitely encourage you to go out and talk to people and get feedback on your ideas. I mean, the strongest competitive advantage that a startup has is that it's nimble and it can shift direction very quickly, and that's something definitely to be taken advantage of. So to get started, a little bit about the firm. I think Rob alluded to some of these elements, in terms of Wilson Sonsini in particular, certainly the largest player in representing technology companies in financings, as well as M&A transactions, as well as IPO transactions. We even managed to get on the intellectual property hot list. So I'm not sure how any law firm would be considered hot, but we're on there anyways. So that's a little bit about the firm. We're organized in a way that allows us to represent companies at all stages of growth, from early stage startup phase to sort of early public company IPO phase to multi-billion dollar public companies. And the way our firm is organized is to basically have a core corporate group that handles the early stage organization and formation with folks like myself, and then have a range of specialists in all of these related areas that are here at the firm and that are called in to help provide complete set of support and service to companies as they grow. So moving on to the subject of tonight's event, and the idea of certainly early stage financings and trends in that area. Certainly, we are seeing that, the level of activity, is sustained. There are ups and downs from quarter to quarter. Our firm on our website actually publishes reports on trends in the early stage financing environment. So on the WSGR website, you can access those reports. But some of the trends that we've seen is that, the structures and the money is certainly moving into the early stages, which is good for folks that are looking to get early stage startups funded. We are seeing, pre-seed rounds in place of what used to be seed rounds, seed rounds in place of what used to be a Series A round. So we are seeing companies getting multiple funding rounds done before they actually go to a venture firm for a Series A financing. And so, people are getting creative through, incubators, through, individual investors, friends and family. All kinds of creative structures are being developed to help companies get that initial funding, which is the hardest funding really for a startup to get, and to get it in increments. So you're getting, enough to get you, off the ground and achieve certain milestones where you're at a point where you can attract additional capital. So it's not about really convincing a venture firm to put $5 million into your company on day one. Certainly there is a lot of early stage funding activity being done in the pre-seed and related rounds. Venture firms are still very active as well. We are seeing very large late-stage rounds where venture firms are providing growth capital to mature private companies. It's almost a rite of passage now that when a large, successful private company is thinking about doing a public offering, before they do that public offering, they'll do something in the range of $100 million venture round or private equity round to basically just secure their balance sheet and really, and you hear about this in the headlines all the time, companies like Lyft or Uber doing very large private financings at very high valuations. to really validate the company and their model. So not directly relevant to startups, but certainly part of the overall dynamic is that we are seeing more late stage rounds. We're seeing sources of funding coming in from foreign investors as well, who are organizing funds and focusing or at least opening up those funds to investment in in Bay Area startups. The funding environment and the ecosystem certainly has become more global. U.S. investors are investing abroad. International investors are investing actively here in the Valley as well. And there are certain instruments like the SAFE instruments, which we'll talk about later, that are being used to get a small amount of money into startups relatively quickly and painlessly on sort of an accepted template or standard form, which helps. I mean, these documents, the SAFE instruments, we'll get into more detail, but they're really structured to create a simple set of terms and conditions on which a startup company can raise funding, either through an incubator or through an angel investor or a combination of the two. So those are some of the higher level trends. Certainly, funding is still critical for early stage startups. I think the emergence of cloud-based technologies, SaaS solutions, has certainly lowered the development cost and the amount of capital that's required to launch a business. But still, definitely CapEx costs are always going to be there. I think certainly hiring and paying a team here in the Valley is getting more expensive every month. We're seeing a lot of early stage companies looking outside of the Valley and hiring development teams in places like Canada or Mexico or Europe, really globally India, of course, and sort of traditional places like India and China are still very active as well. But outsourcing, even for early stage startups, does help startups to kind of bridge that gap where they have very limited funding and a lot of development work to do to attract additional investment. So certainly companies are attracting more sort of pre-seed and seed investment. There are a lot of incubators that are very actively investing small amounts in a large number of startups. So you've probably heard of a Series A crunch where, there's a large number of private companies that have received some funding, but are now struggling to sort of cross the threshold to a Series A and attract venture financing. And that's partially due to the fact that, there is, a lot of seed money now available that is funding companies that are not necessarily clearing the bar for a Series A. So certainly, the companies that are, quality companies are, making that transition from a sort of friends and family backed startup to a venture backed company. We've had, early stage startups, in the last month I've worked on probably 3 or 4 where companies have gotten through and secured Series A funding. Certainly there is a lot of, investor optimism still. I mean, the markets are fluctuating, the public markets, go up and down, but, the venture community, has seen enough of that. I think there hasn't really been an impact on the venture community or the investment community into private companies yet. And a certain level of volatility in the public markets is not unexpected. So in terms of the overall sort of ecosystem for financing startups, there are, as multiple different sources, starting sort of with the incubators and accelerators and angel investors, such as Y Combinator, AngelPad, et cetera, that allow companies to get a small amount of funding, develop connections within sort of a network of related ventures, and compete for additional angel and micro VC money. You've got plenty of micro VCs that are active and emerging in the Valley and nationally. Then we move into sort of larger rounds of funding, sort of between $1 million and $5 million, where those used to be considered Series A rounds. Now many are calling them Series seed rounds with small venture funds looking to get into companies early enough to to make a difference and acquire a meaningful equity stake. One of the challenges that's always been the case when you're raising angel investment is convincing the angel investors that your business is a logical and sustainable investment for the angel investors. At whatever stage you're raising money, the investors have to be convinced that their model is going to work. The rate of return that their model demands is ultimately going to be realized or has potential to be realized. And so certainly angel investors have always been wary of business models that require a large amount of capital, because they understand that following the angel round, this company is going to need multiple rounds of venture funding to really get to cash flow positive. And so for businesses that are very capital intensive, they find the angel market less receptive to those. Although in today's environment, as I said, with sort of cloud-based development platforms and technologies, people are able to get to or plan to get to cash flow break even without having to do sort of $50 or $100 million in venture financing over multiple rounds. So convincing the early stage investors that their equity stake is not going to be wiped out through multiple subsequent rounds is certainly part of the challenge in attracting early stage investment, as you might have already discovered. But then we move into the larger stage rounds, sort of the traditional venture rounds of the Series A financings, and then beyond that, in the Bs and the Cs can get over 50 million and even up to 100 million for later stage private companies. So the ecosystem has definitely changed over the last 5 years, and there's certainly a lot more options for getting funding and structuring funding. We'll get into those in more detail later. Before we do, I did want to touch on a few things about preparing for funding. Certainly, we represent a lot of companies from inception, but we also represent companies that have been around for a few years, have really been on a very tight budget, and come to us when they're at a point where they've attracted an investor and they're looking to basically negotiate and close an equity round. And at that point, we end up having to do a lot of cleanup and catch up because the company's really not prepared to actually close on an equity investment. So a big part of getting an equity investment or any investment round closed is certainly convincing the investor on the merits of the business and the business model, but also being prepared for the level of scrutiny and diligence that an investor is going to do, even after they commit to funding your business, maybe even presenting you with a term sheet. That's really the beginning of the process as opposed to the end of the process for actually securing that investment. So being prepared, having your ducks in a row really makes a big difference in terms of getting from investor interest to investor funding. And so, having the company properly organized, maintaining the records of the company, having the equity position of the founders properly documented, if they're going to be vesting requirements applicable to the founding team, having those clearly spelled out really makes a big difference. I mean, yes, it's tempting to focus on the 100 other things that you have to deal with as a startup entrepreneur, and just figure you'll deal with the paperwork later. But certainly, we've seen a lot of early stage companies suffer in situations where they haven't done the paperwork, and a founder ends up leaving before things really get to the point of funding, and you have basically a hole in the company's history. And if that former founder is no longer supportive of the business, it can be almost impossible to get that business funded without the cooperation of that former founder. So you don't want to be in a situation where you have an interested investor, but you're just not able to get present a clean record of the business to actually get that funding in the door. In addition, IP protection. Certainly as a startup, you're not going to be actively filing a lot of patent applications. You may do one or two on a tight budget, but what I'm sort of referring to as IP protection is more about sort of certainly documenting who's been involved in the business, who's had a hand in developing the business idea, the technology, the intellectual property of the business, and ensuring that those people have all entered into an agreement with the company. You formed a company and they've signed agreements with that company either as contractors, advisors, or in some cases employees. You typically don't have a lot of early employees for an early stage business, but you have to have an agreement in place that is designed to assign that intellectual property to the company and make it very clear as to what the individual is getting for their contribution, so there are no issues or disputes on that later. So basically record keeping and maintaining those records is an important part of positioning a company for funding. So now moving on to the types of early stage investment and the elements that form or define different types of early stage investment. Certainly key elements would be, certainly one is, as an entrepreneur you ask yourself, okay, well, how much do I really need to raise as part of my first round or my first investment? And as I mentioned earlier, the first financing you raise is the most dilutive financing that you're going to raise for your company. You'll end up giving away more equity likely in that first round than in any subsequent round if things go to plan. So, you want to raise the right amount to basically get the company to a milestone, to a value creation milestone. So ultimately, if you feel like, getting your first customer or rolling out your prototype will help to enhance your value proposition to an investor, then initially you might raise just enough capital to get you to that milestone, and then raise additional capital once you've hit that milestone, because then you can raise it at a higher valuation. So by valuation, just to cover some of the basics, if you're starting a company and you're raising, let's say, $100,000 as your first investment round, and it's going to be an equity round. It's not always an equity round. You could have other forms of investment, but if let's say you're doing an equity round, you're looking to raise $100,000, an investor comes to you and says, okay, well, I'll give you $100,000 on a pre-money valuation of $100,000. Effectively, what that means is that after the investment, the company's got a valuation of $200,000. And if the company is worth, according to that investor, $200,000 after the investment and $100,000 before, and that investor's putting in $100,000, then effectively they're saying that they expect to own 50% of the company after they make that investment. So $100,000 on a pre-money of $100,000 is effectively giving away 50% of the company. So that's sort of the math and the dynamics and how valuation impacts ownership percentage following the investment. So you certainly want to maximize the valuation and minimize the raise, although there's always the balance in terms of, okay, well, if you raise more, you provide yourself with additional runway and an additional insurance to achieve your targets and your milestones down the road. So you have to strike that balance between, raising enough and not raising too much at the given valuation for your early stage investment rounds. So size and valuation are certainly key. The source in terms of where the money's coming from is always important. Obviously, your first investor is a key partner in your business. I mean, you have active investors and passive investors, and you certainly want to have an understanding as to what role that investor will play beyond simply writing a check. Is the investment going to be a debt-based investment? Is it going to be a loan to the company that has to be repaid at some point in the future? Or is it going to really be a true equity investment with an ownership stake? What kind of control rights will that investor get in the future decisions of your business, whether it's sort of day-to-day operational decisions, whether it's major decisions such as when to do the next round of financing, whether to sell the business, whether to do a major strategic transaction. Depending on the size of your first investment and the party doing the investment, those rights can be really all over the map. And so you want to really think about what the expectations are and what you're comfortable with. So this is sort of a long list of the different types of early stage financing that startups occasionally do, and for this slide anyway, the picture is actually slightly relevant and to the actual subject of the slide. I can't say that's true for the rest of them because I think there's sort of pictures randomly placed throughout the slide, so don't necessarily look for a connection between the pictures and the text of a slide, but in this case it does apply. So I mean, you've heard of many of these. Certainly bootstrapping is a common and painful approach that sometimes for the right company is the right approach. And for most companies it's sort of the default approach for the first months of its existence. A related form of financing is founder preferred. It's a fairly recent development, but effectively, we'll talk about sort of how founder preferred differs from, traditional sort of founder financing. Friends and family, of course, are always a source of funding, and whether they're willing to or sort of guilted into it, they'll always be there as a key source of early stage funding. Customer financing can be a very valuable but complicated source of funding that we'll talk about. Then, of course, incubators, angels, seed round, convertible debt, convertible equity, safe instruments, crowdfunding, and then, of course, a Series A venture round. So we'll move through these, in the following slides. I'll try and move fairly quickly through them. As Rob mentioned, if folks do have questions during the discussion, you can, rather than raising your hand, perhaps just kind of walk up to the microphone and then I'll call on you once you're there. I think the setup here is intended to encourage people to think about their question as they walk up and be prepared to articulate it. But like I said, questions are welcome, and you don't necessarily have to wait till the end. But jumping into bootstrapping, I mean, it's not something that you necessarily need a slide on or an extensive discussion of, well, what is bootstrapping funding? It's fairly obvious that it's effectively the founder team sort of scraping together what they can. But it takes different forms. When you form the company, initially you incorporate the company, and if you're doing things right, you'll issue the founder stock to the founders. And the founders, in exchange for their founder stock, will write a small check to the business, and they will also contribute or sign a document that assigns their rights to the business plan. If there's software, source code, or other intellectual property, they will assign that to the business, if things are done properly. So there's an initial amount of capital or cash that you put into the business when you buy your founder shares, but because you're basically buying shares in an empty shell, the amount of money that you put into the business for your shares can be next to nothing. It could be $5 if you wanted it to be, because effectively you're buying shares in an empty company, and so that's effectively what they're worth. But obviously as time goes on and you build value in the company, that value will increase. But it's important to understand that whenever you issue shares, whenever a company issues shares to team members, those shares have to be issued at the fair market value. Because, for example, if you're working at a regular employer, an established company, and that company issues shares to you for free, that's going to be considered income to you. So it's the same thing when you start a company. If the company that you started and founded and that you're working for issues shares to you for free, then that will be treated as income to you, because effectively your employer is giving you something for free or for a price less than fair market value. So effectively, whenever you're issuing equity to team members, including founders, you want to issue it at fair market value. When you first form the company, that fair market value is very little, and so you can buy your founder's shares at a very low price. And that's why you want to do this and get this step taken care of early on. So once you have done that, then 6 months passes and the company needs more money, and if you're fortunate enough to have cash on hand to put into the business, the question is, well, what should that cash infusion look like? What should the terms be? Typically, founders will simply just put cash into the company's bank account. Hopefully you've set up a separate bank account for the company, and you'll simply transfer money from your personal account to the company, and you'll just say, well, hey, I'm putting this money in, it's my company, no big deal, I'll get it back later, or a company will pay me back later, or whatever. And oftentimes, that money just sits there until the company gets outside investment. You have a venture firm or an angel investor that comes in to put $500,000 in the company, and at that point you say to the angel investor, hey, I put $50K of my own money in the company. As soon as you put in $500K, I want to take my $50K back out because that was a loan. And at the time, most people don't have any documentation to that effect. They might have bank records, but certainly no sort of promissory note or loan documents or anything like that. And it really ends up being something that gets negotiated with your first investor as to, well, should you really get that money back? Most investors would say, hey, if it's a small amount of money, 5, 10K, and you really need it out of the company, they'll let it go because it's not going to make a difference. But generally, investors like to see the money they put into the company remain in the company and be used by the company to grow the business. So they're not going to want to see a large chunk of their investment, leave the company, and go to repaying the founders. They'll say to the founders that, hey, yes, you put money into the company, and you built a company that's interesting and attractive enough for us to invest in, and we're giving you a pre-money valuation of, let's say, $1 million. And so you're getting credit for your time and the money you put in the business by virtue of the pre-money valuation that we're agreeing to, which is, let's say, $1 million or $5 million even. So that's something to think about when you are putting money into your own business. How do you expect that money to be handled and accounted for down the road? Sometimes founders will say, well, I'll just give myself additional stock. But I'm not going to take a million shares for $5 like I did when I first invested in the company. Now the company's gotten further along, and I already have a lot of shares, and so I'll put in $10,000 and I'll get 10,000 shares more. I don't need another million shares. In that situation, putting in $10,000 for 10,000 common shares basically constitutes an admission by you that now the stock is worth $1 a share. And so going forward, any new team members that you hire will then also have to pay $1 a share for their equity. So you have to be sensitive to pricing your stock. And so again, if you're going to put additional equity in and you're going to buy common stock, be sensitive to what price per share you're paying there, because you don't want to then have to tell all of your new hires that, hey, I know most startups will grant options for 5 cents a share at this stage, but we can't because we're at $1. So that's not a situation you necessarily want to get yourself into. So one of the solutions to that is founder preferred. So if you're looking to put some cash into your business, you don't want to upset the fair value of your common. You want to keep that low for purposes of hiring new team members. Sometimes founders will invest in what's known as founder preferred stock, and effectively, it's a placeholder. It's a certain number of shares in the company that is subject to conversion. So effectively, it's a placeholder that says, hey, I'm putting $50,000 in the company. I'm getting founder preferred shares, but ultimately when the company does an outside investment round, like a Series A investment round, my founder preferred shares, my $50,000, will roll into that outside round and effectively be priced down the road, and I will get some Series A preferred or Series C preferred in exchange for my $50,000 down the road. That way your common stock price is not affected, and ultimately you get additional equity in the company. You get credit for the money that you put in. Of course, you don't necessarily have $1 million worth of founder preferred issued to yourself, because the larger the block, the more of an issue it becomes for later investors. If you have a small amount of founder preferred that's rolling into the next round, the new investors are going to be fine with that. But if you have, let's say, $1 million in founder preferred and you're raising $1 million in new money, And then effectively what you're saying to a new investor is, yeah, put your money in, but the founders are going to control half of the new round. So that tends to make investors a little more uncomfortable. So it's something to bear in mind as you consider a founder preferred round. Friends and family, again, this category relates more to the source of the money as opposed to the structure, because obviously friends and family don't typically come to you with a term sheet laying out the terms and conditions on which they'll invest. It's pretty fluid and pretty flexible, and we'll talk about different structures for early friends and family investment. Some of the things we talk about later, like convertible promissory notes or convertible equity, even the SAFE instrument, which is effectively a type of convertible equity, is something that could be used for friends and family round. Typically these are not rounds that are heavily negotiated with a lot of back and forth of negotiating control rights and protective provisions. It's not a lot of money, and hopefully your friends and family are not going to rake you over the coals on terms and conditions. Some of the things to watch out for, obviously, some of the obvious ones in terms of personal relationships, value add, the amount of money is limited, and there's always a temptation, since it is friends and family, not to document the investment. And nothing makes professional investors more nervous than a company that has undocumented equity rights outstanding, because it creates uncertainty now and much more uncertainty down the road. If a company is ultimately successful, these people with undefined rights will come out of the woodwork. So this one is customer funding is definitely a very valuable option for companies depending on the industry. It can provide a source of non-dilutive financing. You're not spending a lot of time negotiating control rights or even valuation for customer funding. Funding aside, certainly any startup should be talking to customers from the very outset. Sure you've experienced the value that talking to your end customers or your target customers brings to the table. In terms of refining your business model, your product or your service, but also in terms of securing early stage funding. If you do have a relationship with a potential customer that sort of really connects with your business plan and your development roadmap, and is anxious to see you move forward and get access to early versions of your solution, that can be a very real source for some initial funding. While there's less negotiation or even no negotiation over valuation and control rights, since much of this customer funding comes in the form of prepayments for access to products and services. So you avoid a lot of the typical investment negotiation, but there are commercial terms that get negotiated as part of these customer funding rounds that you definitely want to handle carefully. Terms of access rights. These early customers will typically ask for most favored provisions, where they get the best terms that you agree to give to anyone. If you give better terms to anyone else, their terms automatically default to that. They get exclusive access in certain areas, or early access in certain areas. And then development rights. What can they do with the product or technology that you give them access to? Can they develop it further? Can they build on it? And if they can, who owns it? So certainly ownership of intellectual property rights, limitations on commercial rights, all of that gets negotiated as part of an early customer funding event. So there's definitely work to be done on these transactions as well, but can be a valuable source. We've had clients that have basically gotten through the first year through relationships with large established companies that are potential customers. And of course that helps to attract investors too, if you're able to get the attention and resources of a large established player that's interested in potentially becoming a customer. Incubators, I mean, certainly they're well documented and very active source for support for startups. I think they have a lot of value to add, not only in terms of financing, but certainly, of course, in terms of feedback, connections, support, networking, and community. There's certainly a long list of incubators and how they help companies and how they invest in companies varies from incubator to incubator, but that's usually a mix of they'll get some amount of common stock in the business, and these incubators are sophisticated enough to realize that they don't want to mess up your common stock price. So effectively, they will pay a very low price for the common shares and put in a small dollar amount for the common stock. So they'll get some amount of common stock at the founder price, but that's not really a meaningful amount of cash for the business. The rest of it really comes in the form of convertible equity. So they'll put in between $50,000 and $100,000 in additional cash, not for common stock, but for convertible equity, which we'll talk about a little further down, but effectively it's again a placeholder that allows the company to take the money in and basically determine the valuation and the rights of that money down the road when it closes a larger funding round. And there's certainly blind pool financing available as well from some incubators where they have sort of relationships with investors that will allocate a fixed amount to participants in the incubator program. So that's part of that dynamic as well. Angel investors, as we talked about earlier, I mean, they certainly have always been a part of the funding community and play a big role in startup financing. You have organized angel groups like the Angel Forum that are basically comprised of a kind of a loosely affiliated group of individual investors that kind of pool their time and resources to invest in startup companies. And the approaches they take, sometimes it's common stock, but more often it's either convertible debt or convertible equity. So some angel investors will insist on getting an equity stake in the company at the time of their investment, which means that you do have to negotiate on valuation with them. You can't sort of put that off or defer that to the future. You have to have that discussion, and of course, the founders will have a high expectation on value, and the angel investors will come in low, and you really have to work your way to a meeting point somewhere in the middle that enables you to get an angel investment round done at a point where you're getting enough capital and the angel investors are getting enough equity in the business to feel like they are not going to be diluted to the point of a meaningless stake down the road. So certainly the dynamics for angel investment can vary depending on whether it's an equity investment or a convertible equity investment. I recently did a transaction where an angel investor was investing in a company that was started by some close friends of his. So they were basically happily marching towards this investment until of course the lawyer comes along and screws everything up and tells them that they need to actually spell out the terms of the investment, the valuation, the rights of the investor. And when I started asking questions to this group of friends, the investor said, well, of course I would want these rights. And the founders were saying, well, of course we don't want to give those rights. And so, there's definitely some work to be done there in terms of, not only setting the valuation and pricing the angel investment, but determining, okay, well, what type of decisions will the angel investor have input on, and what decisions will be, controlled by the founding team. And of course, one of the big ones is, the next round of investment after the angel round of investment. If you're going to do, let's say, another angel round or a Series A round after this angel round, who has the right to approve or disapprove that? Can the founders basically agree and set the terms on their own? or will they require the approval of the angel investor to do the next round of funding? And there's a slight difference in interests. I mean, certainly the angel investor does not want the company to take money at a lower valuation than the angel investor put in. So the angel investor may have different ideas of what the right terms are for the next round from the founding team. And so that's where people start to get nervous about, okay, well, if I give the angel investor a veto, will they block a financing round down the road that the founding team really wants to do? So that's, and it's not, there are no hard and fast rules as to whether you have to give the angel investor a blocking right or not on a future round. Sometimes, if it really gets contentious, people agree to give the angel investor a right to block a future round if that future round is below a certain valuation. So effectively, the angel investor has protection that, hey, the company is not going to do something that is going to reduce the value of their investment directly without their approval. So there's sort of kind of lines that can be drawn there to make that work in the context of an angel investment. The Series Seed investment is kind of a hybrid of an angel round and a Series A venture round investment. It is certainly commonly used today. There are, in fact, simplified Series Seed forms available online even. Now, I would definitely, as an attorney, counsel you to consult with an attorney before actually executing and using any form that you find online, even if it's from a website that I give you here that is prepared by our firm, because there are subtleties and circumstances that vary from company to company. And so, whether it's forming a company or funding a company, there's a lot of information available online in terms of forms and sample agreements that are tempting to simply just take and run with, but certainly you want to at least have someone with experience take a look at those to make sure that they're being used properly in your situation. But the Series Seed forms are intended to create kind of a streamlined, simplified set of documents that allow companies to move towards getting a funding done on market terms, generally market terms, without spending a lot of time and energy on details that don't really directly impact an early stage investment, such as dividend rights, since companies, even mature private companies, typically are not issuing dividends, registration rights, which are rights to basically register the stock after an IPO, anti-dilution protection, voting agreements, things, a long set of representations and warranties. So those are the types of things that get stripped out of a Series Seed round to try and simplify the round and allow it to be kind of more plain English and understandable to the average founder and the average sort of early stage investor that may be sort of, a seed investor, maybe friends and family, maybe folks like that really just want simple plain English documents that people can understand and are not looking for a lot of bells and whistles on the documents themselves. So seed round documents tend to be simpler in terms of control rights. There are not a lot of veto rights or blocking rights that investors would have in a Series Seed round. There are some protections and preferences for investors built into seed round documents, but as I said, there is a lot of activity at this stage now for startup companies as opposed to Series A rounds. Things to watch out for if you are doing a seed round of financing. Certainly you want to make sure that, like I said, you're not simply taking standard forms and not thinking through what the forms actually provide for. If you're looking to modify those forms and do things differently to reflect your circumstances, the forms are certainly not set up for a lot of kind of customization or creativity. So you want to be careful there. I think that certainly seed round structures and documents do go a long way to help simplify the process and get the parties focused on on getting a financing done, on understandable and terms that actually are relevant for an early stage company. So historically, a lot of startups have turned to convertible debt as their first round of financing. And the biggest advantage and the draw for convertible debt was that it's a placeholder. You have an investor who's interested in putting money in your business. You believe the business is worth $10 million. The investor's not so sure, and you're just not able to get to an agreement on what valuation should be assigned to their investment. What convertible debt does is allows you to move forward with the investment by issuing the investor a convertible promissory note. And these things typically provide that, hey, the company has received $100,000 from the investor. The company agrees to pay that $100,000 back to the investor after 1 year if the company has not conducted any other financing within that 1 year. So certainly most investors that take this convertible debt don't expect to get paid at the end of that 1 year. It's really a misnomer to really look at this as debt. Ultimately people have always understood this to be an at-risk equity investment, and it's very rare for a convertible debt to get repaid ever. But it's set up to have a 1 year maturity because the investor wants the comfort of knowing that, hey, if the things are not going well in 1 year and you haven't gotten additional funding, that the investor will then have some ability to at least ask or demand for their money back. The company probably wouldn't have the money, but it gives the investor some comfort and control or some leverage over the company after 1 year. But the documents also provide that if within that 1 year period, the company does complete a Series C round or a Series A round or any other equity financing, that the convertible note would actually convert into that equity financing on the same terms as the equity investors. So it pushes the equity investment down the road, but allows you to take some investment up front without necessarily agreeing on what the valuation should be. It basically defers that till the actual equity financing. Now, there are a few catches. I mean, certainly the investor would expect that, because they're putting their money in sooner, their convertible note would actually convert into the equity round at a discount. So if the Series C round or the Series A round is done at a price of $1 a share, the convertible note will have some discount to that, typically sort of a 25%, 15 to 25 to 35% discount, depending on sort of your leverage and how, where you're able to sort of end up in your negotiations. But, it'll convert at a discount into the next equity round. And the next equity round can't be sort of a $10 equity financing. There are conditions such as, the equity round has to raise at least, $500,000 or $250,000 in new cash, depending on, your business plan and your funding needs. This convertible note will say, hey, in order to trigger a conversion of this note into equity, the new round has to have, at least a minimum amount of additional cash coming into the business for it to actually trigger the conversion of the note. If the new round does not meet that threshold, then there will be no automatic conversion. There may be an optional conversion where the investor has an option of converting into that round at a discount, but not automatic. Now, one thing that's developed over the years is that investors have realized that by putting in money early on into a convertible note, they enable the company to build value and secure equity financing down the road at a higher valuation. And yes, the early investor has a discount of 15, 25%, but if ultimately, the convertible debt investor's money enabled the company to do really well, and the seed round or the Series A round is at a very high valuation because the company is really, successful or has really done well, the convertible note investor ends up paying a much higher price on conversion of their note. So investors have gotten wise to that and have now built in provisions into their convertible notes that put a cap on the valuation. So, it's not simply a 25% discount to the next round, but rather it's, the lower of a 25% discount to the next round or a maximum valuation of X. And so they'll say, hey, the maximum valuation for my note to convert into equity should be $5 million. Today, at the time the convertible investment is being made, when the investor is putting $100K into your company for convertible debt, let's say the investor's telling you the company's worth $1 million, you're telling them you believe the pre-money valuation should be $10 million, and you can't agree, so you are doing the convertible debt. The investor's going to say, well, I want basically a ceiling on the valuation at which my money will eventually convert into equity. So it's not just 25% discount to the next round, but it'll be capped at a certain number, whether it's 5 million or 8 million or 4 million. It's really something that gets negotiated between the company and the investor. But that's definitely becoming more prevalent and part of the negotiation, whether you're doing convertible debt or a convertible security or convertible equity. So the difference between convertible debt and convertible equity is that this element of a maturity date, a 1-year maturity date, saying, hey, if you don't raise additional money within 1 year, my promissory note becomes due and you have to repay it. That concept people recognized was artificial and really didn't reflect the substance of what people were really doing with these early stage investments. So convertible equity has all of the same features as a convertible debt that we just talked about. In other words, it's a placeholder that will convert into equity at the time of the next funding round, as long as the next funding round is of sufficient size to meet the threshold. But there's no maturity date, so founders are less concerned or less nervous about having to repay this note in 1 year's time or in 18 months' time. And also it has the benefit of not having an interest rate associated with it. So effectively with the convertible equity, the amount that's in this placeholder remains fixed at 100K. It's not 100K plus 8%, accruing, monthly or annually on the convertible note. So convertible equity is certainly becoming more common and certainly more preferable from a founder perspective as well. And the safe instruments that have been introduced by incubators like Y Combinator are a form of convertible equity. So I mean, it stands for simply agreement for future equity, and it's a short sort of 6-page agreement that outlines really what we've talked about, which is the investors putting in money, 100,000 or 50,000 or 200,000, whatever the early stage investment is, and the safe instrument, the agreement, is really a placeholder that says, hey, if within the next year or really at any time you're able to complete an equity financing, then this money will roll into that financing at a discount, subject to a maximum valuation ceiling or cap. So if you're successful and you're able to do your Series A round at a pre-money valuation of 20 million, but before that you did a safe or a convertible equity round where you raised 100K with a valuation cap of 8 million, then basically at the time that you do your Series A financing, what you'll end up doing is issuing Series A shares to the new investors at a price per share, let's say of $1 a share, reflecting the $20 million pre-money valuation. But at the same time, you will be issuing Series A-1 shares to the people who invested in your convertible equity, and they will get that Series A-1 stock at, let's say, 50 cents a share, reflecting sort of the maximum valuation cap that they had negotiated at the time of their investment. So you end up really doing 2 rounds in one, because there is a difference in terms of the price that the new money's paying relative to the old money. And that creates an interesting dynamic as well, because a lot of, some startups actually are very attracted to this idea of convertible equity or convertible debt because it allows them to kind of put off the valuation discussion for months and in some cases even years. So we've had startups where basically they've raised convertible equity over and over again from friends and family and from angel investors over a 2-year period, and raised up to like $3 million in convertible equity, which is great to have that amount of capital come into the business and allow the company to hit a lot of key milestones so that they are able to attract a venture investor for a Series A financing. But at the time you do a Series A financing and you have a venture investor that's willing to put, let's say, $5 million into the company at a pre-money valuation of $10 or $15 million, that investor is going to be uncomfortable excuse me, with the idea that you have this $3 million in old money that's rolling into the same round as they are investing in, but at a much lower price. I mean, if it's like half the price, if the valuation cap is such that the old money is rolling into the round at 50% of the new money's price, the new investors are effectively going to be minority investors in their own round, where the old money is going to have more shares in the round than the new money. So that makes new investors uncomfortable, and you typically, often see a situation where the new investors say, well, wait a second, we don't want to be part of the same round. We'll let you convert that convertible equity into equity based on its terms, but it'll have to be a separate round. So that'll be your Series A, or your A-1 will be your Series B, and we'll have separate rights and preferences and move forward on that basis. Some cases they even insist on you going back to your early investors and renegotiating the terms of that early round because it's so big and becomes such a big part of your capitalization table that the new investors are just not comfortable with having the early investors own such a large chunk of the company and have that kind of influence over the company as a separate block going forward. So there's often a negotiation there as well. So that's something to keep in mind. If you get into a situation where you are, raising multiple rounds of convertible equity and the dollar amounts start to get high. So we've touched on most of the elements of convertible equity. Crowdfunding is the next one that is becoming an attractive tool for certain types of startups. I think certainly crowdfunding is more attractive and more effective for certain startups such as consumer goods and related companies, where they can not only sell equity in the company but also offer early access to their products. But before we dive into crowdfunding, I'll take the question.
Okay, so this has to do with the SAFE documents or convertible equity. Right. So I just moved from Utah, and so traditionally up there it's round by round by round. But I've heard I like the idea of rolling rounds, like small ones, like 25,000 here, 50 or 75 or 100. So is this common down here, and are the entrepreneurs successful at giving earlier people better terms because they get them off the fence type thing? What's the story on rolling? No,
it's a good question. I think certainly many founders, try to employ the strategy of, incentivizing investors to get off the fence with limited time offers of better terms. And where you're raising money as part of a distinct financing round, yes, your initial round, let's say it's convertible equity, you can argue that the valuation cap would be lower and the discount on conversion could be higher because they're putting money in earlier and taking greater risk. And so, that's logical. And sometimes, certainly for your first round, let's say you do a round of convertible equity on those terms, and then 6 months later, you look to do another round of convertible equity. And because you've made progress on the business, and there's less risk in the business, you're not inclined to give the second round of convertible equity the same discount and the same valuation cap because time has passed. And it's really a matter of leverage. It's a rational strategy, and you can certainly articulate to your new investors that the old money came in 6 months ago and therefore had higher risk, and so that was the situation then. You're further along now, and therefore the discount is lower and the valuation cap is higher. And if there's enough separation in time and milestones have been met in between, then that can work, and I've seen it work. In other situations where it's kind of been 15 days since your last raise, because you don't have to do this all at once. You can take, you can issue convertible equity in increments, and from a fairness as well as a legal perspective, you are required to disclose to your new investor, what you already have and what the terms of that are. And it's not necessarily something that you want to volunteer, such as, hey, our last guy's got, a much lower valuation cap and a much higher discount. There is some element, there are some elements of that legally you are required to disclose because you are selling equity in the company, and certainly you could see a situation where, if you had, a very generous early stage convertible equity round, and then you did a later one that was far less generous, and you didn't tell the later guys about the earlier one, and then come, your Series A financing, they both converted in, and the later round was dwarfed by the earlier one, there you could very well have a securities lawsuit on your hands, because you are obligated to provide the level of disclosure that a reasonable investor would expect, and provide material information to those investors about what equity obligations or convertible equity obligations you already have on your books. So you can have different terms. There just has to be a justification, a rational story behind it.
Okay, is that, so simple question, like a small one on that one. So is that 15-day scenario, for example, I have 3 people here and they're just kind of waiting for the first person to take the dive, right?
Yeah.
Is that 5 or 10 or 15 days? Have you seen that successful very much in that scenario?
Yeah,
or
I have not. Typically, the investors that come in 15 days late will say, well, if you want my money, you got to give me those terms as well. If you're not going to give me the terms, I'm not going to move forward. So, unless, they're really motivated to make the investment and just miss the boat on the first round, it's tough to get them to accept the fact that, someone who came in, 15 days earlier is going to get better terms than they would. Yeah, please, come on up.
Just a short question. What happens if a company never raises? So they've collected the safe and they never raised a round. Is that a sunk cost, or the investors lose the money? Or
Yeah, effectively, the instruments will vary, but some of them will have kind of a default conversion feature where if you don't raise money within a 2-year period, for example, the investor would have the option of converting into equity at a valuation that's agreed upon up front. And you recognize that that's not an ideal valuation. It'll be lower than what you would like, but you do have a year or two to get a valuation done at a higher level, so you don't fall back into that default scenario. And it does make founders nervous to say, hey, I'm putting kind of a default valuation in the documents, and I'm going to have to show these documents to my later investors. They are going to see the ceiling valuation, and they're also going to see sort of the default valuation, and that may lead them to kind of be in that range and not beyond it. And so, my advice and what I've seen work in practice is to do what you have to do to get that angel investment round done. Later investors will recognize the fact that valuation is very time specific and term specific. And the fact that you agreed to a ceiling with your convertible equity round investors 6 months ago doesn't mean that that's what you felt is going to be the fair value of your company 6 months later. So most sophisticated seed and venture investors will recognize that that was a very time-specific valuation, and they can't really use that against you in the context of their valuation discussion.
Gotcha. And if the equity converted doesn't mean anything because the company went out of business, then they just lost the money, or is it not that simple?
Right. I mean, if they convert into equity and the company shuts down, certainly they lose their money. And the way these convertible equity instruments or the safe instruments are structured, ultimately, even if it remained as, if it hadn't converted and the company simply shut down, they would ultimately lose their money unless there was, liquidation proceeds. But there's certainly no founder liability there unless there was fraud or other kind of mismanagement of the company, sort of gross mismanagement.
Thank you.
Sure. So we're getting close to the end. I think crowdfunding was one of the later items on the list. It can be a valuable funding source for early stage companies in the right space. Certainly if you're operating in an area that requires you to remain in stealth mode and not sort of reveal your idea or your concept to the world, crowdfunding is not going to work well for you. Companies like product companies, consumer product companies have certainly found some success in this space. It's an area where the securities laws are evolving. Historically and even today, you can't simply advertise that you're looking for funding. General solicitation, while there are some developments in the area, you're really not permitted to simply put an ad in the newspaper or in any kind of mass media soliciting investment in your business. The crowdfunding sites, at least the stronger sort of more reputable ones, such as AngelList, can basically provide you with the right approach to it, which is what they will do is they will pre-screen investors to confirm that they are accredited investors and only provide access to those pre-qualified investors to view investment opportunities on their site. And that way you're not basically offering your investment opportunity to the mass, to the public or to the world. You're offering it to a subset of pre-screened investors. And so that's how some of these more mature crowdfunding sites are able to comply with securities laws and help companies to get funding. Series A financings, certainly we've talked briefly about them already. Certainly there are important elements of a Series A financing when you get to that point, some of which are also apparent in earlier stage financings. But we could spend a couple of hours on sort of negotiating a Series A financing term sheet. It's not the first round of funding that you're going to do as an entrepreneur, but it's one that you definitely will want to be prepared for down the road when it comes up. But elements of it that are sort of key are certainly valuation. Of course, the higher the pre-money valuation, the less equity you end up giving up in your company. One thing that often comes part and parcel of a valuation discussion is your option pool. A startup company doesn't necessarily have a stock option plan when you first form the company. I mean, that's one of the things that we discuss with founders when we represent startups, so brand new startup companies is, hey, should you set up an option pool right away? You don't necessarily have to because, like I said, when you're issuing founder stock, the price of the stock is very low, so the founders simply buy the shares, which is better from a tax perspective because you start your holding period in your shares. So founders never issue options to themselves, they issue stock. It's the same for early team members. Your price per share is still a penny a share or 2 cents a share, and so early team members are also able to buy their shares outright rather than get stock options. But down the road, when you have a financing and your Series A investors coming in and paying $1 a share, let's say for Series A preferred stock at a $10 million pre-money valuation, then the fair value of your common stock will be higher too. Let's say it's now 20 cents a share. And so your employees, your team members are not going to be willing to write a check for 100,000 shares at 20 cents a share because that becomes real money. And so in those situations, they would prefer an option. And investors will, when they invest in a Series A financing, they will spend a lot of time talking to you about your option pool. How big should your option pool be? Who do you expect to hire? and how much of your equity should you reserve for your option pool, for your additions to your team, and for retaining your team. And that option pool will become part of the negotiations, and it'll become part of your cap table as well. So the investor will say, hey, I'm willing to invest at a $10 million pre-money valuation, and I see that you have 8 million founder shares outstanding. I think you need an option pool of 2 million shares. So effectively, that means that your cap table is 8 million founder shares and early team member shares, plus an option pool of 2 million. So effectively, before my investment, you have 10 million shares on the books, not 8 million. And if I'm giving you a pre-money valuation of 10 million, effectively, that's 10 million divided by 10 million. So basically, I'm paying $1 a share for my investment. So investors like to build in that option pool into your cap table before they make the investment. That way, they're not diluted by it. The founding team is diluted by it. So that's also part of the negotiations for Series A financing. It's sort of what valuation are you going to get for the financing? How big is your option pool going to be? Is it the right size? And is it at the right for your company and your valuation needs? Other things such as control rights, how many board seats will the investor get is certainly relevant, not only at your Series A round, but for a large angel round, you may end up giving an investor a board seat. And an early stage investor that's putting $25K into your company may ask for a board seat. So there's nothing to stop someone from asking, and it really depends on the dynamics of the situation in terms of how much money they're putting into your business, how much value they could add to being on your board, and what is the overall size of the board and how would it affect the voting dynamics. I mean, typically the founders are on the board. If they do a large angel round of sort of $500,000 to $1 million, you typically will have a representative, an angel investor on the board, and so you may have 3 founders and 1 angel investor. Typically, you prefer to have an odd number of board members for voting purposes. So you might have 2 founders and 1 angel investor, but for most angel rounds, the founders will still have a majority of the board. When you get to your Series A financing, that often changes, and the venture firm will insist on a neutral or balanced board where the founders have 2 members, the investors have 2 members, and then you have an independent sort of industry expert that serves as kind of a tiebreaker or an independent mutual director on the board. So board composition is also a key element of a Series A financing negotiation. Choosing the right VC financing partner, certainly an obvious part of the process and part of the considerations in completing a VC round. We talked about key parts of a Series A term sheet. Founder vesting is another one that I didn't mention earlier, but when we form companies and issue shares to founders, we recommend that founders do apply vesting to their shares, even though they don't have to. I mean, no one's going to force them to. But if you have a team of, let's say, 3 founders, there's a temptation to just say, hey, we'll just take our stock free and clear. It's just the 3 of us, no need to apply vesting. And then 6 months later, one of the guys leaves, and they're like, well, hey, how come he gets to keep his stock? So that's one reason to apply vesting from the beginning. Another reason is to have a vesting schedule in place and accrue vesting credit before you get to an investment round, so that you can then explain to your investor that, hey, we already have vesting in place, and we've given ourselves credit for time served, but we're still subject to additional vesting, which tends to be an easier discussion than having no vesting in place and having the Series A investor or the angel investor impose vesting and say, hey, it looks like there's a blank slate here. Let me tell you what I think the vesting should be on your founder shares. So it's always better to have your own schedule in place from the beginning that's more defensible at the time of a Series A negotiation. Question?
Yeah, as a follow-up to that question, first of all, thank you for taking the time to talk to us today.
Absolutely.
So would there be any reason, if you're bootstrapping a company, to not assign yourself a percentage of the company at a zero valuation and just fill out your 409K section IRS form? And if
Absolutely.
so, if there's no reason to do that, is there kind of some math on what percentage that might be?
Right. So I mean, certainly, if the company's plan is to be bootstrapped initially, founder funded, whatever you want to call it, then yes. And even frankly, if it's not, I mean, when you first form the team, the sooner you incorporate the company and allocate shares to the founding team, the better, because it's at that initial incorporation that the valuation is effectively zero, and you can acquire your founder shares for $100 or less, whatever you think is the right amount to initially put into the business in terms of cash contribution. You can go ahead, issue your founder shares, apply vesting to those shares, and allocate the shares amongst the founding team. Typically for a startup, we'll have 10 million shares authorized, and 5 million, out of that 10 million, 5 million will be allocated to the founding team. And whether you've got 3 people or 5 people or 2 people, you kind of determine, okay, well, what should the relative ownership of the founders be? I mean, if they're all making an equal contribution to the business in terms of time and effort, or if some people are putting in cash, other people are putting in more time, you ultimately come to a decision as to what are the relative contributions of the founders, and you allocate that 5 million share block amongst the founding team, either on a 33% to each of 3 founders, or whatever the right allocation is, and you apply vesting to those shares. And you're right, and it's an important point, is that if you are going to apply vesting, it's critical that you file an 83B election form with the IRS indicating that you're buying shares subject to vesting, but you're filing the 83B election so that it's basically a non-event for tax purposes. Basically, the 83B election says to the IRS that you're electing to be taxed on your shares on day one when you get them, not as they vest. And on day one, when you acquire the shares, they're basically worth little or nothing. They're basically worth a fraction of a penny, which is what you're paying for them. So you're paying the fair value. There is no gain, and there's no tax. So you want to be taxed on day one. So you file that election to get taxed on day one. If you don't file the election, then you get taxed as the shares vest. And you paid a fraction of a penny for the shares, but over time, as they vest, hopefully they're going to be worth a lot more than that, and you don't want to be taxed on the difference. So, did I answer your question?
Yeah, you did, perfect.
Okay.
Just a quick follow-up question. So my corporation's already set up, it only has like 1,000 shares. So
Yep.
I can just turn that 1,000 into $1 million someday later on down the road as long as it's percentage covered.
Sure. You could allocate the 1,000 shares, according to whatever percentage ownership you want the founding team to have. And then down the road, you would just do a stock split, and each one share could become 100 shares if you wanted to. I mean, so that's fine. Thank you. Yep. So that's founder vesting. Sure. I mean, we're kind of in the middle of kind of the Q&A session now anyway, so you're welcome to come up.
Yeah, so what are the ranges that you should have in like really early, what should for bringing on new, employees, whatever?
Right.
What is the right value of the shares that I should be looking at?
Sure. I mean, in terms of compensating new team members, the pricing of the shares is relatively simple because, the founders paid a fraction of a penny, and over time that value creeps up. But until you really have an equity financing, there's really no arm's length third-party issuance where you could say, okay, well, that's evidence that, that this is what the fair value of my shares are. So for an early stage private company, unless you just got sort of $1 billion contract from a customer, you have a fair amount of discretion in terms of how that price creeps up over time. Certainly the founders pay the lowest price. People who come on sort of 2 months later, that price might have crept up. But you kind of manage that. It goes from sort of 1/10 of a penny to a penny, maybe 2 pennies 6 months down the road, 5 cents, a year down the road. But if you have no equity financing and no significant major milestones met, then you have sort of the discretion and flexibility on pricing. In terms of what percentage you give people in the company as they join the company, that's a tougher question, right? Because it depends on the individual, the amount of their contribution to the company, their skill set, what it takes really to attract them to the company, what they bring to the table. And you want to plan for that. You want to kind of identify what your hiring needs are, what your sort of build-out plan is for the team, and how you expect to allocate between those team members, because ultimately people are going to talk and information will get out in terms of relative ownership, and it's not always done perfectly, but you want to do your best to make sure that you're right sizing and being fair across the organization. There are some surveys and databases that are available for subscription online, and they have compensation surveys that basically fuel or basically feed off of participants. So you agree to participate in the survey, you provide your compensation information in terms of what you're giving your new hires in cash and equity. You also pay a fee, but then you get the benefit of the entire database. And it's broken down by industry, by stage of development of the company, stage of funding, and they'll give you sort of average, median sort of compensation data, which helps. But again, for an early stage company, it's very individual specific and case by case. Yeah. So I mean, and you want to get to a point where you're offering people a number of shares as opposed to a percentage in the company eventually. Early on, yes, people are going to expect to want to know, hey, what percentage does this 100,000 shares represent? But eventually you want to get to a point where you're talking only about shares and not committing to percentages, because obviously percentages change over time.
Right, and you said that the event was what really triggers the valuation. How do these like equity loans and those impact that?
Yeah.
Does it get pushed out?
Right, I mean, absolutely. Like certainly an equity financing is a valuation event. And the investors will get, they're not getting common stock, they're getting preferred stock, or they'll get seed stock or something with additional rights and preferences. So if you end up issuing stock to investors at $1 a share, doesn't mean that from now on you have to grant people, team members stock at $1 a share, because there are differences in the rights and preferences of the preferred stock versus the common. So it will cause your common value to go up. But not all the way up
But
to
it'll be a fraction.
Yeah, and typically once you do get meaningful outside investment, then you end up spending about $3 to $5K on getting a formal valuation done, which it's not sort of, they're not going to force you to go up to kind of the full preferred price. They'll work with you on that valuation, but they apply sort of more accepted standards to come to evaluation.
Okay, thanks.
Okay, sure. Yep.
So employee option pool seed stage versus A round. What are some best practices there? Because maybe as a founder, you want it to be at the A round, depending on the development of the company or the
Right.
stage of the company.
Right.
Do the angel investors, and seed stage investors require that option pool at seed, and what you can do about
Sure,
it?
sure. Yeah, I mean, it's not uncommon for an investor in a seed round, particularly if it's an experienced investor and it's a sizable seed round, sort of in the $500K to $1 million. That investor is going to want to know that you've got a meaningful, reserve of shares for new hires, and whether you put that in an option pool or you set aside, actual stock for those new hires, the investor is going to often ask for, that option pool or that allocation to be made. And again, the investors don't want to be diluted by those issuances. They feel like, okay, from an investor perspective, it's as if, they're coming into the business. They know that you're going to have to hire people, that there is, at least for, the next year, there's a known, quantity of people that are going to need to be added to the organization, and those people are going to require equity as part of their compensation package. And so the investor will view that situation as a given. And so, there was a time in the past where one could argue that, well, that's a go-forward, expense. It's not a current expense. And yeah, sure, we're going to have to issue equity to new team members going forward, but yeah, every company has to issue equity, even for new investment going forward. And so, once the angel investor comes in, or once the preferred investor comes in, they should be in the same boat as the founders, and every new hire should dilute everybody equally. And so, for a while, that was that worked. But eventually, the market practice and the investor leverage has kind of ended up in the current situation where, at least for kind of a one-year period following their investment, they want the new hire dilution to be basically built in before their investment. So they're not saying that you need an option pool that's going to last forever or for the next 5 years, and so the option pool needs to be like 50% of your cap table. But they will say, hey, we think that over the next year, if we're putting in money that is expected to last a year, we think that during that 1 year period, you're going to need to hire this many people for this amount of equity. And we think you should reserve for that now, and that should be reserved in the cap table before our investment, so that effectively, we are not diluted by it. That's already there. And so, like I said in the example where you have 8 million founder shares, they want 2 million option pool shares to be in the cap table. So instead of pricing their shares as if you had 8 million shares, you price on 10. So it's a matter of kind of rationally walking through with investors kind of what the hiring plan is, what the expected equity is going to be to attract these people, and getting agreement on that, because you can't just arbitrarily say no, it should be 15% versus 5%. Kind of the way that we see that kind of issue resolved is to kind of sit down and do a kind of a hiring plan, and then walk the investor through that and say, we think this is the right number. If you propose an option pool of 15% and the investor is saying, no, it has to be 30%, it's probably because the investor thinks that there are additional management changes that need to be made in the company, and additional management hires, potentially even a new CEO that requires a bigger option pool. So that kind of gives you an indication as to kind of where they're thinking the management team is in terms of being developed or not too. So that's kind of the discussion that happens not only in Series A rounds, but also in seed rounds. Okay?
So what's the difference? What are the positive negatives of the size of initial shares that are issued to the founders? When my previous company, I did 15 million founders, but that was my investor told me to do that. But here, I hear people talking about 8 to 5 million or whatever. It's
Sure.
maybe 10. What's the positive and negatives of doing 15 versus
Right,
like 5
right.
or 8?
No, it's fair point. I mean, it's somewhat arbitrary. I typically sort of authorize 10 million to start and allocate 5 or 6 million to the founding team. Really, I mean, ultimately, you could do anything. You could authorize 1 billion shares. The challenge is being fair to your new hires, and having a reasonable kind of market level cap table and not an inflated cap table. And sure, 10, 15 million, that's not a huge difference, and that either one is fine. But you don't want to have sort of authorize kind of 100 million shares just so that you can offer every new hire 300,000 shares, because eventually people will see through that and resent you for it. But logically, the thought process is that for a typical technology startup company, their goal is to form the company, do initial Series A round where you have sort of 6 million founder shares. Maybe you end up with an option pool of 2 million shares, and then you issue 2 million shares to your Series A round or to your angel round. So after your first round of meaningful funding, you have 10 million shares actually outstanding. Then maybe you do a couple more rounds of financing. That creeps up to maybe 15 million, maybe 20 million shares after a few rounds of funding. And of course, you're increasing the option pool with each of these rounds. So you can get to 20 million shares pretty quickly. At that point, if you're a mature private company, you've gone through several rounds of funding, you've got 20 million shares outstanding, and you're thinking maybe of conducting an IPO at that stage, 20 million shares is a good place to be, because most companies, when they go public, at least historically, kind of $200 million is kind of the average or valuation or minimum valuation to go public. So assuming you go public at a $200 million valuation, that's going to mean your price per share is $10 a share. And that's a good place to be for an IPO. And underwriters, bankers typically target an IPO price of between $10 and $15 a share. What happens with a lot of private companies that have inflated share counts is, yes, they do well. They hire a lot of people, grant options, everyone's happy, and then they're excited about going public, but they have 100 million shares outstanding, or even 50 million shares outstanding, and the company's valuation in an IPO is going to be 200 million. And so the underwriters will say to the founders or to the company, hey, you need to do a reverse stock split and go from 100 million shares to 10 or to 20 million. So like a 5-for-1 reverse stock split will have to be done before your IPO, which then means you have to go around and tell every employee that, hey, remember your option grant that you had for 100,000 shares? Well, now it's actually, we're going to reduce it to being an option for 20,000 shares. And remember, your option exercise price used to be $1 a share. Well, now it's $5 a share. And even though technically it's the same company and the same percentage ownership before and after the reverse split, emotionally that's not a good thing for people to go through. So that's kind of the reason to try and manage your share count at a rational level, so that ultimately on an exit you don't have to go back to your employee base and tell them that you're going to be doing a massive reverse stock split just to make the numbers work on an IPO. So that's really the thought process on it. But I think anything between sort of 10 and 20 million, with founders getting between 5 and 10 million, works. And if you authorize 20 million but you only issue 10 million to the founders, then frankly the founders still own 100% of the company, because obviously, of course, ownership is tied to whatever shares are outstanding, not what you authorize. The authorized is just what's available for future issuance, but ownership is tied to what's outstanding.
Okay, thank you.
Sure.
Hello, Asaf.
Hey.
So as a big law firm, you can provide not only with knowledge, but also with connections. But I always thought that as a big law firm, it's not cheap to work with you. And as an early stage startup, we always have not a lot of cash, right?
Yes.
So
yes.
what's the option to work?
No, I'm glad you asked that question. Definitely a good point to discuss. Like I said early on, don't be fooled by the lavish surroundings. We do work with with a lot of startup companies, and we recognized early on, probably before any other law firm in the country, that you have to be creative in working with startups, and you have to make the economics work for startups. And that involves, investing time and effort in companies before they're funded in a way that doesn't drain the little funding that they have, in a way that works for the founders and works for the company. And so we for many years have done that. And the way we do that is by effectively representing startups, even if they have no funding, helping companies get incorporated, get founder stock issued, get the right agreements in place in terms of forms for advisors, for consultants, for intellectual property, NDAs, even angel round financings, all of that. We work with early stage companies so what we would do is we would track the time that we spend on it, and we would actually issue invoices and reports to the company, but we would not expect payment. So effectively, payment is deferred until the company does actually get funding. So that helps on the cash burn side, so you're not using your initial cash. But at the same time, you have the option of going to LegalZoom and just pulling forms off the internet and not running up a legal bill at all, right? So in that situation, and for that reason, we also are sensitive to the amount that we do bill, even though it's deferred. We know that you don't want to be seeing bills for $10,000, $20,000 showing up in your mailbox every month because that can add up very quickly. And if you end up doing sort of a $500,000 angel round, you don't want to be spending $100,000 on legal fees. So the process is to really, or the goal is to really streamline the formation documents, the incorporation, the founder documents, the service agreements with employees, consultants, even like the angel financing and the seed financing documents. Do that in a way that's simple and streamlined and cost effective. So we would incorporate a company, get it up and running, really get all of the foundation built in the 5K range. Then we can do an angel round of financing, again, like on sort of these safe instruments, again, sort of on a 5K range. So just because the fees are deferred doesn't mean sort of we go crazy and run them up. Frankly, because we're investing that time and that investment is at risk until you get funded, it's in our interest as well to be efficient. We don't want to spend 3 days on something that could be done in 2 hours because our time is being invested and it's at risk just like your time.
May I paraphrase if I can?
Sure.
So you actually said that can you work with any startup?
Right.
Can I just enter your office and say,
Right,
I'm
right.
interested to work with
Sure.
you, can you just serve us?
Yeah.
And we will not pay
Right.
till we fundraise. So
Yeah.
maybe it's
So there is
yeah.
a process, absolutely. I mean, for example, if the guy with the airplanes with extension cords came along and said, hey, I'd like to work with you, we probably wouldn't move forward with that. So there is a process. And I think, coming from New York to the Valley, I found that, there's a lot of, faith put into entrepreneurs here in the Valley in general, but certainly at this firm. And so we take, ideas and people very seriously. And there is a process where, we will sit down and talk to you and certainly have a call or a meeting. Get an understanding of the business proposition, get an understanding of the team. If there is a business plan or an executive summary, that's certainly helpful to get as well. And at the very least, we will provide feedback on it in terms of, hey, we sit through hundreds of investor pitches a year, and we talk to investors within our network. We understand what they're looking for and what kinds of questions they would have. So absolutely, we would provide feedback on enhancing the pitch and the plan, and then we would actually take that pitch internally to a new business committee and say, hey, I'm talking to this startup, here's their executive summary, and it'll be a summary that reflects my own comments, and then that new business committee would then, consider that and approve a plan to move forward or come back with suggestions, additional suggestions. And suggestions may be to kind of consider other, places to spend your time, but typically they're more constructive than that. And, we have sort of a dialogue. Sometimes it goes back and forth in terms of refining it. So it's not sort of every company, every sort of founder that walks through the door, we just sort of automatically represent. There is a process, but I think that process is beneficial whether it ends up in an engagement or not. And if it does end in an engagement, or even if it doesn't, we've been in the Valley for many for many years, and certainly have a broad network of companies, investors, angel investors, venture investors, and people that we connect with regularly. So I mean, we do certainly offer that sort of networking and introductory service as well, in addition to sort of the legal stuff.
Thank you very much. And the last
Okay.
question.
Yep.
We want to work with you, and I'm pretty sure a lot of people want to work with you here.
Sure,
Do you
sure.
have cards? Do you have contacts?
Absolutely. Yes, I mean, so the materials are certainly available. I've got my contact information here, but it'll also be available in the deck that gets posted by the site. I do have a few cards as well, and happy to stick around and talk to folks after we formally wrap up. But are there any other questions before we do that? Yeah, please.
Yeah, hello, sir. I want to know more about how do we convert those convertible notes or SAFE if they have, in a practical way, if they have pro-rata rights. Because the new investor will probably give you a valuation and give you some certain amount of money, means percentage.
Yep.
But what happens if the previous investor insists on maintaining the percentage? So when that kind of situation happens, that being a founder and founder's team will be stuck in the middle and probably diluted a lot. So yeah, I want to know more about in the founder's perspective, how can we do that?
Right. No, I think that's right. I mean, normally if there are kind of disagreements or sort of tug of war between old investors and new investors, it is the founders that end up getting diluted or bearing the brunt of the dilution
Exactly.
associated with that. But certainly if you have convertible notes or convertible equity, and the new investor is uncomfortable with the amount of discount on the convertible notes, or is uncomfortable with allowing the convertible note investors to invest and participate in the new round, that's certainly something that would get worked out. I mean, typically, yes, if you've got a big discount on the convertible equity, the new investor will say, hey, I don't want this convertible equity coming in alongside my money. I want it to come in before my money, and therefore your cap table gets bigger because a convertible debt is now part of your cap table before the new round. And so the new round is now priced off of, instead of being priced off of a cap table where you have 8 million founder shares, 2 million option pool shares, it's now priced off a cap table that has maybe 12 or 13 million shares, because the new investors are saying, hey, you need to add your convertible equity onto the cap table as well before my investment gets priced. So yes, it's true that then the founders bear the brunt of the dilution associated with having that in there. And that's one of the reasons why you don't necessarily have kind of a large convertible equity round before your new round, because oftentimes you do end up having to take that dilution as a separate pre-financing addition to your cap table. But I mean, ultimately it's a matter of leverage, right? I mean, if you've got a new investor that is very interested in investing and willing to work with you on striking the right balance, that helps. Again, going back to your convertible equity holders and indicating that, hey, we've got $5 million or $3 million of additional investment at the doorstep, but they're uncomfortable with the level of discount and the amount of equity that's going to the convertible guys, and so they want to adjust that. Oftentimes you have situations where the convertible equity holders are willing to work to kind of some sort of middle ground so that they don't get the full discount, but they get a part of that discount to lessen the impact on the founders, the dilutive impact on the founders. So it's all, I mean, it's not a complete answer, but I mean, it really leverage is the biggest part of that equation. I mean, if you've got investors that are really interested in coming in, that helps. Having existing investors that are supportive and willing to work with you helps as well. Because ultimately, I think one of the lessons that investors have learned over the years is that, just because you can take something from a founder doesn't mean you should. Because ultimately, they're the ones that are going to build the business and build the value of your investment. So, not only do the investors have to be taken care of, but the founders have to be taken care of as well. And the good investors recognize that and will work with you, both on the prior investors and the new investors, to ensure that the founding team and the broader team have the right stake in the business.
Okay, thank you.
Sure.
Hi there.
Hi.
So first, just a factual question. When you were talking about the convertible equity and the safes,
Yep.
are there any aspects where they are considered as debt? The reason I'm asking is that we have a government grant that it's a small business innovation grant, and in the second phase, when it grows, 10 times bigger,
Yeah.
they look a lot at what the company's debt capacity and debt burden is.
Sure, sure. No, I mean, the typical safe instrument or convertible equity instrument would not be considered debt under most accounting or regulatory rules. I mean, they're specifically worded and drafted to avoid elements of a debt instrument. So there's really, like the question that came up earlier, what if you don't get an equity round done? Do you have to pay that money back? And that's not the case. I mean, the convertible equity or a safe instrument does not require repayment of the capital, and so therefore, it's not considered debt under most standards. So, if you're looking to avoid debt on your balance sheet for that reason or for other reasons, then convertible equity or the safe instruments is certainly a good approach to take.
Great. And then the other question is, later on, our business model is our business model is such that the revenue stream is probably going to be very, dependable. And that means that our Series A might be something that we would want to have like a lot of debt and not just equity.
Mm-hmm.
You didn't talk that much about it. What are the best practices to think about when it comes to a Series A that's debt heavy?
Right. So, I mean, do you mean an investment in Series A for a company that already has a lot of debt, or kind of doing a combination of Series A plus debt financing?
Yeah, so basically, so ignore the terminology then. The thing I'm saying is that when we get to a certain state, we're basically going to be in this mode where we're going to have to accumulate a lot of capital assets, but
Mm-hmm.
each asset has a really tight revenue stream tied to it.
Sure.
So it feels like it's something that a debt structure of that raise should make sense.
Right. No, absolutely. I mean, we see many examples of companies that raise Series A financing and debt financing at the same time. They work well together because you tend to get better debt terms at the time of an equity investment. It de-risks the company from the perspective of the lender, and it also increases your runway, particularly if you've got sort of receivables or, like you said, a revenue stream that the debt can be tied to. That's very common. Even equipment financing or specific asset financing through debt can work in combination with a Series A financing. And there are a number of very active, what they call venture lenders in the Valley that are kind of not a traditional bank, but really more of a technology and venture industry lender that will put money into companies that are not large, successful, cash-rich businesses, but are very much growing, emerging businesses that are even cash flow negative. But there are venture lenders that are willing to put real meaningful money into those companies, tied to either collateral like equipment or contracts with revenue streams. So no, I think the combination of a Series A and a debt financing has worked well for many companies.
Cool. Thanks a lot.
Okay, well, thank you. Certainly enjoyed the event, and I'm around to address any questions afterwards, but thanks again for coming.